China, protecting the interests of somebody in Manhattan or Ontario, and it's a beautiful thing. Gold's physicality and indestructible nature, they invite malefactors to kill you and take your property. Bitcoin safely stores your property in cyberspace where it can't be seized by force, and that encourages peaceful negotiations rather than coercion.
Thank you, Michael. Frank, you'll now have a 1-minute rebuttal for that.
Yeah, you're right. You know, there have been a lot of wars, a lot of blood and treasury spent on protecting gold over the century, and that's why, you know, you're making my case that gold has real value. People have fought very hard for it, and they're not about to give it up easily. And so I'm not sure that makes sense. And again, I prefer physical gold. You keep coming back to the paper gold. I agree in some ways about paper gold, but I don't think those issues apply to physical gold. The cost to secure it, but listen, again, you're not accepting the fact that as Bitcoin, if it achieves the value of gold as you're suggesting, it's a sitting duck. It's sitting out in the open and can be easily attacked. I would rather have my money in a safety, my gold in a safety deposit box than out in the open where once it's a threat to the currency, and you can't deny that it's not going to be a threat when you said the U.S. dollar is going to benefit from this. I don't know how you can possibly say that when you're talking about 20% money growth every year, now and forever. That's how you destroy a currency. The U.S. dollar is not going to benefit from this. And Bitcoin is not, if Bitcoin pretends that it's going to provide the solution, I'd rather have my money in a safety, my gold in a safety deposit box than out in the open where once it's a threat to the currency, you can't deny that it's not going to be a threat when you said the U.S. dollar, they will kill it. It's that simple.
Thank you, Frank. Thank you for your rebuttal. We will move on to our next topic now, which is historical performance. Michael, I'll begin with you. Bitcoin is appreciating at 200% a year, and you have said we cannot expect it to expand any faster. So one of Bitcoin's biggest strengths is clearly its price performance, but could it also not present its biggest risk? The higher Bitcoin gets, the more fear of missing out trade catches fire. If this risk-taking behavior continues, isn't it causing a risk in and of itself, since the price may be based purely on speculation? You have 5 minutes on this topic.
Well, I think Bitcoin's getting much less risky, and I'm going to start with a review of the history here. In the last 1 year, Bitcoin's up 693% versus 4.66% for gold. Its Sharpe ratio is 4.7 versus 0.43% for gold. Over 5 years, $1 invested in gold would yield $1.33. $1 invested in Bitcoin gives you $132 for a Bitcoin. If you actually chose gold instead of Bitcoin, you lost 99% of your wealth. It's devastating. Over a decade, Bitcoin's running about 190% on average every year versus 1.65% for gold. And again, the Sharpe ratio is 4x as much. Let's take a century. Well, people know that gold was $20 an ounce, and now it's $1,700 an ounce. And so you could say, well, it's like up almost like factor of 80 or 90. But when you actually risk adjust it, you realize there's nobody that actually got that return over the course of the century. 95% of the gold was confiscated in the last 100 years. So maybe theoretically the United States government might have got that gain, but everybody in Russia, China, every country in Europe, everybody in South America and Asia, they all lost their gold. So if you do a risk-adjusted calculation, you find that you invest $1, it should be worth $100, but you lost it, not all of it, 95% of the time. You got $5. And so the real risk-adjusted return over a century is 1.5% per year. It's not any better than the last decade. It's devastating. Over a millennium, gold, 2,000 years ago, gold was like 80% of money. Gold was money. And then it slid from 80% to 40%, in the Middle Ages. By the time we got to 1940, it's 40, and then 30, and then 20. And today, the monetary value of gold is maybe 5 trillion, half of the gold supply, and the total store of value in the economy is 250 trillion. So you divide 5 trillion into 250 trillion, and gold is 2% of all money. Over that time period, it came with thousands, if not millions, of massacres and seizures. People talk about Bitcoin being volatile, but in the year where Bitcoin went up 693% in 12 months, here are the maximum drawdowns if you look at the end of day closing price on Binance. 13%, 10%, 14%, 11%, 17%, 11%, 25%. That was the worst on 126, 21%, 16%, and 12%. So in fact, in order to get a max drawdown of 25%, to get a 693% advance is pretty historic performance. Bitcoin liquidities increased by a factor of 10 versus normal days over the past 6 months. We had 6.9 billion trade on Binance 2 days ago or a day ago. So you're talking about $10 billion a day in the spot market. Gold peaked August 10th, around the time that MicroStrategy announced that we bought 250 million worth of Bitcoin. And I came to this with a completely objective clean slate. I said, I got to buy gold or I got to buy Bitcoin. But my conclusion was, if Bitcoin works, gold probably won't. And if gold works, Bitcoin won't. So what's the difference? Well, if I'd chosen gold, I would be minus $4 billion today over 8 months versus Bitcoin. It's a $4 billion choice. One is right, one is wrong. As everybody says, gold has a long history of manipulation by governments, banks, and miners. Jim Rickards, the new case of gold, he says the paper market could easily be 100 times the size of the physical market. Quote, there's no doubt we're seeing price suppression through the paper market. Rigging futures is child's play. I respect his comment. Bitcoin's first decade was marked by legendary volatility. There's no doubt, but the assets matured. The network has spread. It's entering its second decade. It's like LeBron James at age 19. The best player is always the most volatile player. If you look forward, what you see is an extraordinary asset on an extraordinary network that solves the problem better than gold can solve the problem. That's why I think it's the right choice, and there's consequence to making the wrong one. Matured, the network.
Michael, thank you for that. Some incredible statements being made here. Frank, you'll have a 1 minute rebuttal now.
All right. Well, I've real trouble with the way you calculate what is happening at any given time between Bitcoin and gold. And I've heard you say this before. Last year, gold showed that it didn't perform versus Bitcoin. Listen, if I chose 1 year periods in Bitcoin over the last 4 years, it would look a lot worse. So you cannot define what the value of gold is based on 6 months or a year of trading. You have to look at it over a much longer time period. That's number one. Number two, I have real trouble with how you calculate your 190% compounded annual growth on Bitcoin. I'll get into that later. But again, I think it's always a function of garbage in and garbage out and how you calculate your returns. Maybe gold isn't used as money today, but it certainly used as a store of value, and it's never failed on that. And again, I will get into that in a moment. In your claim that, listen, you made all these billions on Bitcoin versus gold over a 1 year period, you have to understand what dynamics drove the Bitcoin price up and why gold did not go up. And I think that's, again, I will get into that in a moment, but that in itself does not tell you or demonstrate that Bitcoin is a store of value.
Thank you, Frank, and you will have time to expand here because it's your turn now for your question. In August of 2020, we've said it, gold made new highs of $2,075 per ounce. Gold was up 36% for the year. The M2 money supply continued its unstoppable ride up, and the dollar kept falling. With the stimulus measures, the trillions of dollars of debt, and the Fed doing more easing, gold didn't continue on the path of higher highs. Instead, here we are and having corrected circa 12% year to date. So the most common reason I hear is that Bitcoin has now replaced it as the asset of choice. Economists have even said that gold without competition from Bitcoin, would increase in value by 13% each year for the next decade. So the question is this: did gold's 3,000-year reign as the ultimate currency officially end in August of 2020, Frank?
Well, the short answer is no, absolutely not. And listen, you have to understand what gold is. And again, there are a lot of misconceptions about what the utility of gold is for investors. And first we need to clarify one big misconception. It's not the gold price that you need to be looking at. You need to be looking at how it's measured against certain currencies at certain points in history. And let me give you an example, because it makes a huge difference into the reason why you need to own gold. So let's take the Argentine peso, which Michael loves to use as a means of demonstrating what happens to currencies when they get into trouble, when they're mismanaged, much like what the US dollar is experiencing today. The Argentine peso, gold in Argentine peso terms has gone up 28-fold in the last 10 years. Take a more recent example, the Turkish lira, which is experiencing its own currency crisis at the moment. It's gone up 4-fold in the period. Gold, measured in lira terms, has gone up 4-fold in a period of 4 years. That's how you measure the true value of gold. Also, you need to understand what happens during periods of high inflation. That's when gold performs really well. The last time we experienced that here in North America was in the 1970s, and when gold went from $35 to $850, that's 25-fold, because we had high inflation. Now, we haven't seen in this current cycle high CPI inflation yet. All of the inflation has gone into assets, and that's why we have all of these asset bubbles happening, which one could claim Bitcoin as an asset bubble. And so you really have to understand that part of it, because that's when it's going to become evident. Now, just a little fun fact. Traditionally, and when we talk about what happened with gold last year, when gold has a big down dip, central banks and jewelers come in and buy on the down dip, and they buy big. And we saw this recently with both the jewelry buyers out of India buying record amounts this last month, and with the central banks declaring that on the down dip, they continue to buy at a furious pace. Now, contrast that with Bitcoin. And so when you talk about performance with respect to Bitcoin, it's not an appropriate term. Bitcoin has not been around long enough to be able to determine its utility as a store of value. And I don't buy the argument that a mere 10 years of history is going to be enough to indicate what the future performance is going to be. It's just silly. It's never been properly tested. So is Bitcoin impacting the price of gold? I think partially, yes. I have a good friend of mine who's an economist who recently did a regression analysis on attributing what factors affected gold and why gold turned down. It was about 40% was attributed to higher bond yields. 36% was to a higher US dollar, which was temporary, and 24% was attributed to Bitcoin. So Bitcoin is having an impact, and I can't deny it, but I actually think this is more of a North American perspective than it is a global perspective in terms of this rush into Bitcoin. It's worth noting that the US dollar is still benefiting from its premier reserve currency status. But as the world starts to fragment, the global monetary system starts to fragment, and you have countries like China, Russia, and Iran all looking to decouple from the US dollar for a whole number of reasons. As that fragmentation takes place and less trading is done with US dollars, the dollar will come under pressure, and especially with this money growth that we're talking about. Now, most Americans will only see that when it happens to the US dollar. They will only see the value of gold when it's measured against US dollars. Americans have a very funny way of seeing everything in US dollar terms. On the volatility side, I mean, people have very short memories. Sure, Bitcoin's done very well the last couple of years, but if you take points throughout the last 10 years, it's had stomach-churning roller coaster ride, and there's no reason why that won't continue. So I can't see why anybody would invest in Bitcoin if the objective was to preserve value. Now, on a personal note, Michael, I think you're fighting the wrong fight. Gold is the least of your worries. You need to keep your eye on central banks and governments, because they're going to be the ones that you need to look out for. And I know that Jerome Powell has been dismissing Bitcoin as he dismisses gold as both speculation vehicles. And he's doing the same thing that every other one of his predecessors did, disparages gold, now it's Bitcoin. While they're in office, you know, Alan Greenspan was a gold bug before, then a gold bug after, but during his time as chairman of the Fed, he was disparaging gold. And they do that because it is a threat, and especially if it becomes too popular. So I think investors really need to ask themselves, if they're looking to store value, which one's better, gold or Bitcoin?
Thank you,
I'm
Frank.
choosing gold unless you have some way to change my mind. I still choose gold.
Thank you, Frank, for that. Michael, 1 minute response, please.
You know, you can't achieve the gold performance as an individual due to the seizure risk. Gold bugs for a decade have been viewing CPI and waiting for CPI inflation, and they haven't got it. The inflation came over the last 10 years, and it came to the assets, not to the consumer goods, because of technology and other dynamics. All the money's flowing into stocks, bonds, and other assets. It's not flowing into gold. So gold doesn't turn out to be a monetary inflation hedge. Gold is better in a collapsing currency, but locals can't easily get it, and they can't easily use it like Bitcoin. Bitcoin's the egalitarian solution with more utility. You can put it on a $50 Android phone, and you can buy it with plus or minus 1% markup. Finally, among central bankers, there's a growing consensus that Bitcoin's a digital asset, not a digital currency. That's been articulated by the Chinese central bank, by the US, by Jerome Powell at the Federal Reserve, by Christine Lagarde at the EU Central Bank. And it has the merit of being true. It is a digital asset. You don't buy it to use it as a medium of exchange. You buy it to hold for long periods of time.
Thank you, Michael. We're going to move on to our next topic now, which is supply dynamics. Frank, Michael has said that as the price of gold goes higher, so does the incentive to mine and prospect it, which leads to increased supply. He has also said, quote, ultimately, you have to find something which you can't print more of that doesn't have its fundamental underpinnings tied to a fiat currency. And the only thing I can find right now is Bitcoin. So while gold can be labeled scarce, how do you defend the fact that in theory it does not have a ceiling to supply? You have 5 minutes, Frank.
All right. Well, from listening to Michael in the past, when he talks about gold supply, it's clear to me that he doesn't have a real understanding of the gold mining industry. Just before I talk about supply, let me just clarify on demand. So about 50% of gold demand comes from jewelry, mostly from India, where it has deep cultural ties. About 25% comes from central banks, and they've been buying furiously over the last 10 years. And the other 25% comes from investment. These numbers fluctuate a bit, but they've been pretty steady over the years. So that's the demand side. On the supply side, I think Michael has made some very erroneous assumptions about gold and gold production. I've spent my entire adult life financing gold development and exploration around the world. And I can tell you, even when you find it, it's not easy to mine. The average period between discovery and production is 10 to 20 years and sometimes longer. And the grades are getting lower and lower, and it's becoming very expensive and time-consuming to find these deposits. No world-class discovery has been made in the last 30 years. All the gold discovered in the last 10 years is less than half of the amount of gold that was discovered in just 1 year in 1990, when gold was under $400 an ounce. The gold mining industry is facing an existential crisis when it comes to its reserves. They're depleting, and they can't replace them. Over the last 8 years, the reserves held by major mining companies have dropped 40% over the last 8 years. And as I said, the grades are getting lower, which means you have to move a lot more debt, which raises the costs exponentially. So there is one big problem. And the truth about mine supply that's going to really help Michael here, because I don't think he really understands how price does and doesn't affect gold. In 1971, when gold was $35 an ounce, the global production of gold by mining companies was 1,500 tons. Scroll forward 50 years, gold's gone up 50-fold, 6,000%. That number has only doubled to 3,000 tons a year, which averages out to 1.5% growth per year, which is about the same you see in terms of population growth. Now, comparing it to Bitcoin, yes, Michael's right, Bitcoin's supply is capped, but there's still a supply of 3 to 4% inflation a year, which is obviously declining over a period of time. But I see a lot of risks in Bitcoin before you reach that zero inflation rate. So I see both gold and Bitcoin have inflation rates and supply, and you can argue that both supplies are declining. So I asked Michael, as the gold price continues to go up, where is all this extra gold going to come from? Now, I've heard you talk about asteroids. I've heard you talk about some new alchemy process. And if you seriously believe that, bring it on. But I suggest you don't go there, because I just that just doesn't make any sense. The fact of the matter is that for both Bitcoin and gold, it's not the newly mined supply that you need to be concerned with. It's the existing stock. And the question you need to ask is whether it sticks as the price goes up. And I've got a lot to say about that. So you got to stop saying that there's an infinite supply of gold if the gold price goes up. It's just simply not true.
Frank Justra, thank you for that. Michael, you'll have 1 minute to rebuttal that.
I would say that there's conflict of interest between people that make their living in the gold mining business versus people that make their living or pin their hopes on gold holding. They're actually naturally enemies. And so Frank's life as a gold miner, I think, colors his view of gold. Newmont Mining and Barrick Gold are the two largest gold miners in the world I could find. I read both their annual reports to get ready for this. Newmont mined or sold 5.8 million ounces last year, and they reported 94.2 million ounces in reserves, almost 18 to 1, 18 years worth of reserves. And Barrick mined 4.76 million ounces and reported 68 million ounces in reserves. They found 10, 15, 20 years worth of reserves. They don't have an interest in reporting more, but they don't seem like they're anywhere close to running out.
Thank you, Michael. And now we'll go to your supply question. With a total limit of 21 million issuable coins, the rate of increase in available Bitcoins is not keeping pace with the number of people keen to buy them. So the price of a Bitcoin keeps increasing. Because its price increases, people feel reluctant to use them as currency by spending them. So with Bitcoin supply constrained and falling short of demand, do the supply side dynamics prevent Bitcoin from functioning as a currency?
Yeah, so my view here is Bitcoin's the ideal architecture to be a currency and gold isn't. I started my career modeling commodities, and the history of commodities is as the price goes up, the demand decreases, the supply increases. Gold is a commodity. Bitcoin is a scarcity. As the price goes up, the supply is constant. Historically, all commodity businesses, they need a cartel to be stable. John D. Rockefeller formed a cartel. OPEC is cartel. The De Beer Diamond cartel is the same. If you look at, just about everything in the world, you have to have some kind of restraint of trade. If you can't get it legally through patents or technically through some special sauce, then you have to get it another way to make the price go up. Otherwise, the price doesn't go up. If we build a dynamic model of gold, it works like this. The price goes up. The miners increase output. Jewelry demand decreases. Scrap and jewelry get recycled at increased rates. Bankers and financiers sell more gold derivatives short, and they're more aggressive about it. Investors fund more mining development and mining expansion. Miners come online, capacity comes online, miners sell more gold. Eventually, the price goes high enough, the government stops buying gold, they start selling gold, or they short the gold, the price comes down. That's the problem with having 90 kilotons worth of gold as jewelry and so many tons of gold sitting in central banks. It's a damping feature. When the price goes up by a factor of 20, everybody on earth is trying to make the price come down, and they have a lot of tools to do it, especially because there's no quick link or tight link between paper gold and physical gold. If you look at the dynamic model of Bitcoin, the demand goes up, the price goes up, mining stocks go up. Miners stop selling Bitcoin. Miners start buying Bitcoin with equity and debt, which keeps going up. Investors buy Bitcoin. Companies buy Bitcoin with equity and debt, like my company, which borrowed $1.7 billion at nearly zero interest to buy Bitcoin. Banks can't short the Bitcoin. Governments don't have the reserves to sell to short the Bitcoin. The government has less motive and less capability to manipulate the price down because they don't have it. They can't sell it short. The banks, the mutual funds, the insurance companies integrate and they market the Bitcoin. Big tech, eventually Apple, Google, and Facebook integrate and they market the Bitcoin. And investors buy the Bitcoin. Then they get more investors to buy the Bitcoin. The Bitcoin price goes up. The investors, the companies, and the countries buy the Bitcoin. Gold mining requires $100 billion a year in fossil fuels, labor, chemicals, and environmental damage, and the never-ending struggle to inflate the gold supply and undermine the price. It's providing zero security transport or audit service, and that would cost tens of billions more. I've watched 100 interviews by David Lynn, and I feel bad for him. He keeps waiting for gold price to go up, and he says on 3/15 of this year, he says, and a rhetorical question, musing, what if miners stopped mining gold? And he knows the answer, which is if the miners stopped mining gold, gold would be a good investment. And every gold investor knows this. Bitcoin mining requires $2 billion a year in electricity, $2 billion a year in hardware to provide full security, transport, and audit service for the entire network worldwide. It scales to hundreds of trillions of dollars of assets and annual transfers. It'll support billions of users, billions of nodes, 100 million transactions a year. And it provides the base layer for tens of billions of instant transactions per day on the application layer, i.e., Bitcoin mining is a good use of energy. Gold mining is a destructive use of energy if you're a gold holder versus a Bitcoin holder.
Thank you, Michael. Frank, you'll have 1 minute.
Okay, so again, Michael, you're ignoring what I just told you in my last segment, that the fact is that history has shown that even when the gold price goes up 50-fold, over 50 years, we've only seen a double in the amount of gold mined. So you keep ignoring that, but that's just a fact. Certainly there are, as with any commodity, including Bitcoin, there's always going to be supply when the price moves up. And you know, this concept that a higher price just drives in more buying works to a point. It sounds to me more like a bubble environment than what it's been suggested it should be as a store of value. So I'm still not buying that. You're going to have obviously jewelry scrap sold into rising prices, but as I said earlier, the jewelry demand has been steady year after year after year. It represents 50% of the demand for gold. And now, listen, you can't, if you're going to attack gold on environment and energy, I mean, you can't even go there. I mean, the amount of energy consumption that Bitcoin uses today is the entire population of Nigeria, 90 million people. It's estimated soon it's going to be the entire energy consumption of Japan. And as far as the environment, I mean, most of that hash rate's coming out of China, where there's a lot of coal, including, it's got hydro, but a lot of coal. And there are CO2 emissions that are getting dangerously high and are going to be looked at by the environmentalists. So I don't think you want to go compare environmental damage between gold and Bitcoin, because I think you're going to lose that battle.
Thank you, Frank. We are going to move on to our next topic of discussion, which is ownership structure. Michael, there's a common perception that when it comes to Bitcoin ownership, there are some primary risks. You've already we've already brought up some before, but someone could get access to your private key and take your Bitcoins. You could lose your private key, and that basically cryptocurrency is a technology based, which leaves this investment open to cyber attacks. So if you are speaking to your friend, your best friend, how would you present the risks of Bitcoin ownership?
Yeah, I think when we look at the ownership structure, Bitcoin versus gold, what you have is a dichotomy. Gold owners tend to be a bit cynical, more conventional, less technical, more traditional. They rely upon metrics like CPI and conventional sovereign interest rates. They tend to be diversified. They're traders. Sometimes they're speculators. Bitcoin holders generally are maximalist, and they're believers in the technology as a force of progress to elevate the entire civilization. And it's not a speculation, it's not a trade, they're not hedging. I'm going to give some quotes. Jim Rickards in the New Case of Gold, quote, "Gold's an attractive part of portfolio. Still, it's always prudent to diversify. I've consistently recommended a modest allocation, 10% of your investable assets. My advice to investors is simply to get gold, but not too much." Frank, you said, "What I do best is create and build mining companies. 10% of your portfolio should be in gold. Gold won't keep going up forever, and rotate out of gold following the panic buy." He said that on Stansberry, December 2020. And then the famous Peter Schiff said, quote, "I don't own much gold. I own more gold stocks." At Salt Vegas 2019, and a lot of gold companies don't even have gold. They're exploration companies trying to find it. They're speculations. Newmont Mining, $11 billion in revenue, has $5.5 billion in cash, EBITDA of $5.7 billion last year, paid a massive dividend, $1.45. They actually mine gold at $750 to $1,000 an ounce. They've returned $2.7 billion to their shareholders. They paid $704 million in taxes. They're dividending out 40 to 60% of the free cash flow above $1,200 an ounce. They have effectively zero net debt, and yet they borrowed $985 million at 225 basis points last year. They could borrow 5 to 10 billion more. What does this mean? It means they're mining gold as fast as they can so that they can buy cash. They don't even think it's worth, they could buy $10 billion of gold for 2.5% interest. They don't think the gold is going up. They think the gold is going back to 1,200. Barrick Gold, the same story. They paid $1.3 billion in tax last year at a 27% rate. They're overmining the gold. They're returning capital to their shareholders as fast as possible. $750 million this year, massive dividends. These gold miners don't believe in gold. They don't have any gold on their balance sheet. They could borrow $20 billion at 3% interest and buy gold if they believed in it. They don't believe in it. Talk about hating gold. They could actually cut their sales of gold back and eliminate all their taxes. That's $2 billion in tax those two companies paid. They could take it to zero. Not only did they overmine the gold, sell the gold, drive the price of the gold down, they also paid off, in one case, $12 billion of debt. Barrick did over the past 10 years. They won't borrow money, and they're actually double taxing the gold by paying the dividend. They first pay the income tax rate, and then they force their shareholders to take the dividend rate. And the message is, we don't actually believe gold is money. We don't know what is money. We'll let our shareholders figure it out after we basically drive the price of gold down and pay 50, 60% tax to dividend the money back. It makes no sense. Gold miners are maximizing the gold supply to the detriment of everybody in the gold industry. On the other hand, I ran some polls. 75% of Bitcoiners intend to recruit 3 more people to Bitcoin's cause this year. 43% are going to recruit 11 or more. 84% would rather mortgage their home to buy Bitcoin, right? Not the gold miners, but the Bitcoiners do. 51% of Bitcoiners believe that have more than 51% of their allocation to Bitcoin. And the equivalent is 84% of people that answer my gold poll have 10% or less in gold, and they only half of them answered. So when you look at ownership structure, you have Bitcoin maximalists that view Bitcoin as money. They're optimistic, they're all in, they think the number's going up, they think freedom is going up, they believe in the Bitcoin standard, it's viral, they have laser eyes, it's technology, there's a master plan, make the world a better place through technology. They're more passionate than any of the gold bugs, any other investor group I've ever seen. Gold holders on the other side of the equation, they're a bit skeptical, they've been burned, they're a bit cynical, and even the advocates aren't really willing to commit more than 10% of their portfolio. And it leaves you with the last question, which is, if you're only going to invest 10% of your portfolio in gold, what are you going to invest the other 90% in?
Michael Saylor, thank you for that. And unfortunately, Mark Bristow is not here because I would have loved to hear his rebuttal. But Frank, you'll have a minute here.
Okay, well, first of all, in terms of the portfolio allocation, and again, this is where Michael is confusing what a store of value, safe haven asset, what its purpose is. And this is how we're going to differentiate between what gold is and what Bitcoin is. And he's made a very strong case for why I think you should own gold. Yes, only own 10 to 20% of your portfolio in gold. It's your hedge. It's your insurance. It has the inverse correlation with other asset classes, and it's how you store your wealth. What Michael is describing is a speculation. You know, the buyers coming in just simply because the price is going up, okay? And the idea that you would put all of your money into Bitcoin because there are no other proper asset classes to invest in is simply ludicrous. That's asking for trouble. That's how people get wiped out. As far as gold mining companies, yes, they're not in the business of owning gold. And several companies did try it in the past. Shareholders, because it's a public company, want to see earnings. And then it's up to the shareholder to take his profit from the mining companies or his dividends and invest it in gold if they so choose. That's an individual decision. The way you just described how Bitcoiners are recruiting new recruits, I can't remember what you said, 3 per year, 3 per month. This sounds to me like a pyramid scheme. It gives me all the reasons why I don't want to own Bitcoin.
Okay.
And as far as freedom is concerned and that the freedom is going up, this is just fantasy. We don't live in a world where anarchy will be allowed. And so they can have all these idealistic ambitions. It's just not going to work in the real world.
Thank you, Frank. You'll have more time to elaborate on this because I am asking you the question now. You've already alluded to some of it, but what is it truly about the ownership structure of Bitcoin that makes it hard for you to accept compared to gold? 5 minutes.
Yeah, it's hard for me to determine whether the Bitcoin market is a real market or not. Or whether it's truly representative of a real market. And we have these so-called whales, and their level of ownership, I think, is a big factor in the price trajectory of Bitcoin. Last I heard, and correct me if I'm wrong, these numbers might have changed a bit, but the last I heard, 2% of owners own 95% of all the value of Bitcoin. 1,000 individuals control 40% of the market. Let me repeat that. 2% of the Bitcoin owners own 95% of the value. That, to me, is reminiscent of a penny stock promotion where you have a group of people coming in early, buying large positions in a tightly held deal, and then getting out there and promoting the daylights out of it with wild claims about what it can do and about creating riches. And I just think that that is a very, very dangerous thing. Tightly held deals are easy to manipulate. That's just a fact. Are we to believe that Bitcoin is the only asset class that is not manipulated? Every other asset class is, and that's why we have regulators. Bitcoin doesn't have regulators. That's why it's potentially very attractive to manipulators. And there are many ways to manipulate a tightly held D. Painting the tape and upticking are common methods, but we'll never know. And it should be a concern to us that the price of Bitcoin has been manipulated. That's number one, okay? As far as the recent buyers, I think it's important to take a closer look. We need to differentiate between Wall Street, hedge funds, and the traditional longer-term institutional buyers, okay? And let me start with Wall Street, which Bitcoin folks are touting as an important step in the validation of Bitcoin. I don't take much comfort that Wall Street jumps into anything. They will jump on anything that is going to make them money, and whatever the flavor of the month is, whether it's mortgage-backed securities, tech stocks, SPACs, emerging markets. And when things blow up, as they sometimes do, they just move on to the next thing. If you look at Jamie Dimon of JP Morgan, he hates Bitcoin, can't stand it, but he certainly allows his firm to find business angles to make money out of it because business is business. Hedge funds, and this is where people get really confused. And I hear names like Gunlatch, Druckenmiller, Paul Tudor Jones as all being Bitcoin buyers and therefore lending credibility to Bitcoin. You have to understand what a hedge fund is designed to do, which is very different than traditional institutions. They're designed to look for momentum and take higher risks for higher returns. If the price starts to underperform, they move on to other things. Right now, Bitcoin is giving them momentum in spades, so they're all over it. But if it were to start underperforming, they're in the business of moving out of that and finding something else. And they're certainly not buying into Michael's buy and hold forever. That's just not the way they operate. As far as the institutions, and I think another good example of that is that it's very similar to how, say, Warren Buffett, who was a gold hater for a long, long time, bought a large position in Barrick Gold, and all the gold guys got all excited about it here, and he's a believer. Sure, they bought it, and then he turned around and sold it when he had made a profit. And I'd see Bitcoin, with respect to hedge funds, as being the exact same scenario. Traditional institutions, my good friend Larry Fink just came out, and he manages BlackRock, the largest money manager in the world, $9 trillion under management, came out last week and said he doesn't see any real institutional buying in Bitcoin yet. What worries me are the millions of Robinhood type buyers that are investing and looking to get rich quick. Because when they pile into Bitcoin, and if something were to go wrong, they're the ones that usually are left holding the bag because they're not sophisticated. They don't know how to assess risk. So I just think that you really have to understand who the buyers are to determine what validation is being assigned to Bitcoin.
Thank you, Frank. 1 minute for you, Michael.
People think Bitcoin's a speculation if they don't understand how the technology works. But once you understand a technology is superior, it's not a speculation. As for a pyramid scheme, objecting to something because everybody else thinks it's a good idea doesn't seem, appropriate. Technology spreads virally because it is a better idea. Uber, WhatsApp, iPhone, YouTube, Netflix, they all spread virally. People tell their friends because it's a good idea. As for the 2% of the owners and 9% of the value, I don't even think that's true. That's probably based upon looking at wallets on the blockchain. Most of the accounts are concentrated in custodial wallets controlled by the exchanges. So for example, Binance has 56 million accounts. It's probably got just a handful of wallets that are reflecting those 56 million accounts. So no, I don't think there's any truth to the idea that the value is concentrated with 2% of the owners. I think that's just a misconception. Worrying about the millions of people that are buying Bitcoin, I think it ignores the observation that everything else they could buy is riskier. And so if you dissuade them from buying Bitcoin, you're encouraging them to do something which is riskier. There's no simple answer here. It's a zero-sum game. You either buy the thing that's less risky or buy the thing that's more risky. They got to do something.
Thank you, Michael. We're going to move on to our final topic before our closing statements now. It is market forces. Frank, Michael said that if God designed gold with no imperfections, he would have designed Bitcoin, that it is thermodynamically perfectly sound money. He even said in an interview with me, quote, "There will be a lot of pushback and it will be natural, but it's not going to change the inevitable. The world needs a digital monetary network. It's a $2, $3, $4 trillion problem, and you're not going to be able to stop it." So How do you respond to this market force, Frank, that seems inevitable?
Well, I think you might be right that had God designed it, it might have been Bitcoin. But I think, it doesn't look like he did. Much like God did not design a world of eternal peace, no competition between nation states, no lust for power, no greed, and we're all sitting around the campfire holding hands singing Kumbaya. That's not the world we live in. We live in a very real world of competition, and I think this is where gold plays a very important role in balancing that competition. I think, again, in assessing the market forces, there are two areas that Michael continues to use to make his case. First is how he calculates his compounded annual growth rates, and the second is what I think is his lack of understanding of correlations between asset classes and how that reflects upon Bitcoin as a store of value, okay? First, let's deal with the compounded annual growth. What I've heard from him over and over again is, in all the interviews, he claims that Bitcoin has 196% annual compounded growth, and then he frames it that is going to be achievable each and every year going forward until Bitcoin reaches 1 million, or I've even heard 5 million from him, using statements like it's going to double every 6 months. That's a gross oversimplification and dangerous if you rely on it to make your investment decisions. Calculating compounded annual growth is very sensitive to your entry, starting points, and ending points in the period that you're measuring. It's garbage in, garbage out. And to arrive at his 196% number, he starts at $1 per Bitcoin, $1 in 2011, takes it all the way to $60,000, and which includes the fact that most of that return was front-end loaded into the early years from $1 and up. And I have several problems with that approach. When Bitcoin was $1, it was not a real investment. It was a novelty, it was illiquid, it was tightly held. I'm not sure where you would start the measurement, but it's certainly not $1. I think it's in the several thousands of dollars. Maybe you can look at when Bitcoin crashed in 2017, settled around $7,000, and that's when the real market started. And certainly I think that real investors have only come in the last couple of years. But I think that if you really allow me to just give you a couple of examples, because what he does, again, is, and I've seen it a lot when I'm being pitched by wealth managers. If I were trying to pitch you on buying gold, I would say to you, well, listen, if you bought gold in 1971 at $35 an ounce, and you held it 50 years, it would have gone up 50-fold. That's 6,000%, which works out to about 8% a year of compounded annual growth, which is slightly better than the S&P in that same period. It's pretty good, right? If I wanted to underscore the extreme, I would say to you, hey, listen, if you bought gold in 1971 and you held it for 9 years, which is roughly the amount of time that we're measuring in Bitcoin, you would have had a 42% compounded annual growth. And I think that that's where, you have to always be aware of garbage in, garbage out. Now, again, as I said earlier, he keeps pointing to last year, gold didn't perform, and that's a certainty that it's not, it's not going to survive as a store of value. And like I said, you can pick any one of the last number of years for Bitcoin, and I can paint you a much worse picture. So that's the one part of it. The other part of it is how he characterizes store of value or safe haven asset with respect to what it correlates with, Bitcoin that is, and what it doesn't correlate with. And I think that it's really important to understand that to know, again, where Bitcoin fits in a portfolio. Gold has had a pretty consistent negative correlation with equities and the US dollar. That's a given, and that's what's given its safe haven value. And it's an important portfolio diversifier in the event of sharp equity downturns. By way of example, and this is where I will demonstrate how the correlation works. In March of 2020, when the markets crashed, COVID hit, markets crashed, Gold went down 8% initially in that month and then recovered to break even. It did much, much better in emerging markets because there was a flight to liquidity, which usually has a temporary lifting of the US dollar. If I look at Bitcoin in that same month, it went down 40% peak to trough, ending the month down 25%. Bitcoin only really took off in October of 2020 when it looked like the economy was about to recover, so it was risk on. Gold, on the other hand, did really well in the spring and summer of 2020 when the markets had crashed, QE had begun, and it was risk off. And that's, I think, is the very big difference that you have to pay attention to. If you, like myself, believe that equities are in a bubble, then I think there's a lot of built-in downside with Bitcoin at the moment because it really does behave like a growth stock. I think we have to wait and see if there's a major market correction, and when gold establishes its inverse correlation with Bitcoin, that to me will be the evidence that it is a store of value. And we've never seen Bitcoin tested in a financial crisis. So that, again, US dollar crisis, financial crisis, any crisis, that's where you'll see the true test to Bitcoin as a store of value. The other test is inflation. Gold performs really well in periods of high inflation. And I know Michael is suggesting that we're not going to see high inflation in the CPI, and I think he is dead wrong. You only have to watch the commodity prices going up in price, food prices going up in price. Inflation will hit the CPI. There's no doubt about that. But if you look at the 1970s, for instance, which is the last time we experienced high inflation, gold went up 25-fold over a period of 9 years.
Thank you, Frank. I'm going to have to give Michael his 1-minute rebuttal here.
Yeah, Frank says I'm claiming that Bitcoin will go up 195% a year. That's not true. I've never given any precise estimates for future growth rates. I don't know. I have no crystal ball. I just think it will perform better than the alternatives based upon the laws of physics and the technology dynamics. With regard to time frames, you don't need the 10-year time frame. I think the 1 and 5-year time frame analysis for Bitcoin are also definitive. And is Bitcoin a store of value? Well, I mean, people keep saying it isn't. It seems pretty obvious that something that keeps going up in price and up in value is a better store of value than something which is stably not going up.
Thank you, Michael. I will get to your comments now in regards to market forces. My question for you is this. The macroeconomic setup for hard currency is setting up to be excellent. We have abandoned almost any monetary or financial rectitude, and the Fed has ruled in favor of inflation and hitting the print button on the money machine. So the question is this. With the easy money policy, make the case of why you'd rather be in Bitcoin than gold.
Yeah, I look at the market forces, and as I look forward, Bitcoin's creating global markets in energy, in money, and in finance that operate across all borders and jurisdictions 24/7, 365, and they're open to everyone to participate. If we look at the global energy market, if you take the latest generation of S19 grade Bitcoin miners, you can generate 1 exahash with 30 megawatts of power. At the current prices, that means that energy is worth 45 to 50 cents a kilowatt hour sold to the Bitcoin energy grid. That compares to 13 cents a kilowatt hour for typical residential use or 11 cents a kilowatt hour for typical commercial use. You can use that to drive down the cost of electricity everywhere on Earth. You can rescue stranded energy everywhere on Earth. You can commercialize renewable energy anywhere on Earth. And you can actually create safe, clean income in the developing world wherever you find an energy source, selling the energy at 45 cents an hour, kilowatt hour, which is more than you would get in Manhattan. It's a pretty extraordinary thing. It's never happened before in history. Billions are flowing into this mining sector, and I think that the billions that are flowing in the sector are going to create an incredible global renaissance and disruption in the energy business to the good of the world. The global money market. Bitcoin's creating a global money market. You can actually trade on exchanges in Singapore or Hong Kong, and for a while the contango gets to 40%. That means 40% is the risk-free overnight rate on Bitcoin money compared to a risk-free overnight rate of like 20 basis points in more regulated markets. The derivatives market, the yield curve development, they're all going to explode on the open exchanges from, the innovators at FTX and Binance and every other exchange on the world. They can all plug into the open Bitcoin network. There are rules, but there are no rulers. Even though you might not be able to capture this 40% contango in Alabama as a hodler, you could just buy the Bitcoin and wait, and then hundreds of billions of dollars of capital will find an exchange run by an appropriate entrepreneur offering the right sort of derivatives in order to build out that yield curve and drive asset appreciation. That's a benefit to everybody on the network. If you own $1 billion worth of real estate in California, nothing that happens in Singapore is going to cause your asset to appreciate. And if you own assets that are highly regulated on certain stock exchanges in certain countries, then no innovation in other countries is going to drive up the value of your asset. This global money market's exploding. Spot liquidity has gone from $1 billion a day to $10 billion a day over the course of the last 6 months. The future open interest is exploding, and it's truly disruptive. The third major market is global finance market, and this is Bitcoin-backed payments, credit, insurance, and funds. Big tech is entering this space: PayPal, Venmo, Square, Robinhood. Finance companies, Fidelity, Morgan Stanley, all the major banks, the ones that were skeptical a year or 2 years ago aren't so skeptical anymore. The significance is any finance, insurance, or mutual fund company can 10x the value of their traditional offering by injecting Bitcoin into it. And then any big tech company can become a bank. How explosive is this? Well, I think we'll see 150 new holders this year. I think you'll see $500 billion of assets flow onto the network this year. PayPal, Square, and Coinbase alone have a $500 billion market cap. And if you look at their market cap over the last 12 months, they're all exploding. Morgan Stanley, Goldman Sachs, JP Morgan, Citigroup, Fidelity, Facebook, Apple, Amazon, Google, Microsoft. These are major drivers. Contrast that to the gold market forces. The gold industry continues to market the myth of gold as money while engaging in activities to elevate the US dollar as money. And they're mining in an expensive, dirty, dangerous fashion. They're using 20 times as much energy as the Bitcoin mining network. And manufacturing, marketing, and selling yellow metal is expensive. The next $1 trillion that's spent on gold mining is going to make gold less valuable. Whereas in the year 2035, 99% of the Bitcoin is done. Bitcoin mining is over. The miners are effectively going to be buying Bitcoin. The stock to flow goes to infinity. The stock to flow goes negative. And all of the money spent on Bitcoin mining is to secure the network, provide billions of people with a better store of value to improve energy efficiency, to make the world a cleaner, better, more efficient place. So the market force, I think, clearly favors Bitcoin.
Michael Saylor, thank you for the comments. Frank, 1 minute rebuttal, please.
Yeah, first of all, I have real trouble with you denying your ongoing claims that Bitcoin has performed, has an annual compounded growth rate of 196%, and you use that to extrapolate its future performance. You have said it time and time again. I will actually tweet your words right back at you after this is done, because that is absolutely not true. I think your idealistic view of the world is really just so off the mark. We live in a world where the world order is fragmented and it's getting worse and worse. You're not going to get this global cooperation to get behind Bitcoin, and with all of the energy assumptions that you're making, it's just not going to happen. That's not the real world we're living in. And again, I will go back. If you look at how the governments and central banks will perceive a high Bitcoin price, it's going to be a threat. They will see it as a flight of capital, and they will deal with it the same way that you've seen current capital controls in countries like pre-war Germany, pre-Thatcher Britain, where you could only export 2,500 pounds a year, Greece in 2015, South Africa in 2003. When governments see a threat to their currency because there's a flight to something to get out of that currency, they will go after it. And I think we continue to ignore that risk.
Thank you, Frank. Thank you, Frank. We're going to get to our closing remarks now. There will be no rebuttals. Again, this is a blank canvas to drive your points home. Here we have 6 minutes each. Michael, bring it home.
Gold investors share the same macroeconomic view as Bitcoin investors, but I think they tend to lack one key insight. Money is technology, and Bitcoin's superior monetary technology with powerful network effect. I've watched hundreds of interviews of gold advocates, and they almost never address the technology issue. I found a reference by Mike Maloney 10 years ago, but for the most part, they're not thinking about technology. Diversification makes no sense when there's a correct answer to an engineering problem. You would never diversify the metal in an aircraft wing, or the answer to a math problem, or the shape of a ship's hull, or the oxygen content in a scuba tank. When the cabin depressurizes, you don't place an oxygen mask on 10% of your family. Money is a winner-take-all competition. There is an answer. Choosing the wrong answer has dire consequences. If we contrast the Golden Knight with the Bitcoin Dragon, the Golden Knight's got a 30-year life. It's plodding, stupid, heavy, predictable, and stagnant. Up against the Bitcoin Dragon, the Dragon is immortal, teleporting, dematerializing, hyper-intelligent, rapidly evolving, moves at the speed of light. Which one of these two is going to win the fight? Goldbug say put 10% into physical gold to protect against the bank crash. What about the other 90%? They're not really providing a solution. They're suggesting a hedge. Bitcoin is a solution. Mike Maloney, he says, quote, "The greatest wealth transfer in history is therefore the greatest opportunity in the history of mankind." Well, yeah, if you actually pick the winner in the wealth transfer. If you pick the loser, then you miss out. It would be a shame to actually know this is coming and then miss out. The gold standard fails because gold doesn't sufficiently empower people to control their own property. Governments and banks can tax or confiscate those rights. The gold industry can inflate away that property. Gold coins were too inflexible in the 16th century. They don't represent a solution in the 21st century. In 1914, at the beginning of World War I, the gold standard was thrown overboard within 2 weekends. That's lips from gold wars. The Genoa Conference in 1922 and Bretton Woods in 1944 show the world will at best create a faux gold standard, then corrupt it. If we have gold standards, we are going to get scammed again. Quote, Michael Maloney. Bitcoin addresses this issue by shifting power into the hands of individuals via cryptography and implementing a decentralized security protocol via proof of work. And therefore, it's protecting money from taxation, inflation, and confiscation. Billions of individuals can take control of their money via mobile technology and trade with each other at the speed of light via currency of their choice. Hayek said, "I don't believe we'll ever have good money again before we take the thing out of the hands of government. That is, we can't take them violently out of the hands of government. All we can do is by some sly roundabout way introduce something they can't stop. Bitcoin's a money virus. Nobody's ever defended anything successfully. There is only attack and attack and attack some more. That's Patton. Gold is defense. Bitcoin is an offense. It's spreading at 200% a year. It's going to be to 250 million people by the end of this year. Next stop is 1 billion. Next stop is everybody. The network is worth 25 trillion a year to solve the strong money problem. The protocol is already recruited. Binance, Coinbase, Fidelity, PayPal, MicroStrategy, Tesla. We heard Venmo joined. Next will come Apple, Google, Facebook, and Microsoft. Bitcoin's an economic imperative. It's a technical imperative. It's a moral imperative. Economically, there's $250 trillion of currency derivatives that are debasing at least 10% a year. That's a $25 trillion a year problem. Every investor needs to store value to survive the currency flood. Technically, this is the greatest mobile application. This will be the greatest mobile application. Mobile wallets holding digital currency and digital assets is going to allow 5 billion people to trade with each other and protect their life force. Bitcoin is the protocol that synchronizes 100,000 financial applications in cyberspace. It'll be the kingmaker, and it's going to tip the balance of power in favor of whichever big tech company firm embraces it the most. It's a moral imperative. It's the best hope the human race has for life, liberty, and property for the 8 billion people struggling under the weight of excessive regulation, corrupt politicians, and collapsing currencies and dangerous physical environments. It is an instrument of economic empowerment. It can be delivered to everybody. So, if you believe in sound money, life, liberty, property, and the pursuit of happiness, it's time to abandon gold and move on to Bitcoin. This century, we've digitally transformed messages, books, photos, videos, meetings, newspapers, payments, and relationships. Now it's time to transform money. Bitcoin is hope for a better world.
Michael Saylor, thank you for your closing remarks. This is your time now, Frank, your final 6 minutes to make your case for gold over Bitcoin.
All right, well, I think I've made my case already as to what Bitcoin is and Bitcoin isn't with respect to gold, okay? I pointed out the risks that Michael never seems to want to acknowledge, so now at least people can look into that a little bit more carefully. The idea that rewards come without risk in this world is you can't gloss over that stuff, and I would just want people to understand the risk of what they're getting into. So you can't keep on selling this as a guaranteed winning lottery ticket, and as a cure-all for all the world's ills. You know, some utopian fantasy that you're selling here. This isn't snake oil, and you should stop selling it in that fashion. I know that Bitcoin followers, a lot of them, not all of them, are real idealists. And Michael is promising you that world will be delivered to you. I just don't see it. That's not the world we live in. We live in a very, very competitive, ugly world. And I just don't see he's going to achieve that sort of global utopian vision that Bitcoin is going to answer the problems to everything in this world. The idea that Bitcoin can go up by a factor of 10 times, consume all the value of gold, and then consume all the value of bonds, $300-400 trillion, I just don't see what world that could possibly happen in. It's just, in Michael's world, all you own is Bitcoin. That's the only asset class you own. And that's not the way that you're going. It's just never going to happen in the real world. It's sheer fantasy. And I think that maybe the way you're promoting it, you know, if you only promoted like 10-20% growth, you wouldn't get all of this massive speculation that's going into Bitcoin, which I think is very, very dangerous. But I guess it's easier to promise a 20-bagger or a 100-bagger. But the higher it goes, the more outrageous your claims have to become about what Bitcoin is. And to me, that's very reminiscent of a lot of the research reports I used to read during the dot-com bubble back in 1997 to 99, where they had to justify the price, and to justify the price of some of these crazy assets, they had to make some outrageous assumptions. And this is what I'm seeing here in Bitcoin. Now, I don't want to get personal here, but I just find your style of promotion as misleading and filled with hype, okay? And the one thing that caught my attention, and the reason, that the catalyst to why I wanted this debate, is when I heard you say time and time again that people should buy Bitcoin, hold it forever, and if they need any cash, they should borrow against their car, their house, their businesses. That is such a reckless and irresponsible thing to suggest. I will bet that 90% of your 700,000 Twitter followers are not millionaires, never mind billionaires like yourself. And if these guys are levered up and we have an 80% correction or a 50% correction in Bitcoin that lasts a few years, you're going to wipe out a lot of small investors. And that should really concern you. I also don't like the style in which social media is being used to bully critics, using slogans and campaign, the gimmicks and the slogans like the laser eyes and cyber hornets and have fun staying poor, all this stuff. To me, it smells like a cult. It's cult behavior. It's not serious. And I think if you had more confidence in the value of Bitcoin, you wouldn't have to use that kind of language. So here's the bottom line where I'm at with Bitcoin. I think that we live in very uncertain times. I don't think any one of us has experienced an investment climate like the one we're seeing today. Certainly not in many, many generations. And I, unlike you, don't have a crystal ball. I don't have that benefit. So what I like to do is diversify. You never put your eggs in one basket. That is about the dumbest investment advice anybody could give. So my suggestion to investors is diversified portfolio skewed toward hard assets, because I think that's the environment we're in. And that includes real estate, gold, art, and Bitcoin if you like, okay? So buy Bitcoin. Knock yourself out. It's probably going to go higher. I've said that before. But the best strategy might be, if you're going to buy Bitcoin, hedge it with gold, because that is gold's purpose. So when and if the markets crash, and they will crash again because we are in a bubble environment, you'd be doing Michael, you're doing your followers a disservice by telling them to sell their gold. Sure, go ahead and tell them to buy Bitcoin, and if they want to believe everything you're saying about, go for it. But to sell their gold is the worst thing they could be doing, because they will need it as a portfolio diversifier, because it's inversely correlated with what I think Bitcoin is and what equities are. So I'm just asking you to stop with all the hyperbole. I mean, you're selling this utopian fantasy that is going to probably hurt a lot of people. And I just honestly believe buy Bitcoin, fine, but you have to own gold as your insurance. And I rest my case.
Wow, I have definitely felt the heat in this debate. Thank you both so much for your remarks here. And if I can just add something, regardless of whichever side you're on, I'm sure we can all come to the consensus. This was an incredible debate, perhaps the best ever to be held on the topic of gold versus Bitcoin. And I am honored to have moderated it. And thank you for choosing Stansberry Research as the platform. And if I can just speak for myself and for the audience, for the folks back home, I just want to say this. You are both titans in your respective fields. You have nothing to prove. You are both billionaires, and you are both very busy, and you did not have to do this debate. So I thank you for taking the time to educate us. Thank you.
It was a lot of fun, and I think we both got our points across. So, Michael, thank you for agreeing to do this. And Daniela, you're always, as usual, the greatest host on the planet. Thank you for this.
Thank you, Frank. Thank you, Danielle. Thanks for hosting us.
I appreciate it tremendously. I guess my question is, because I know Michael had tweeted that he was looking to convince Frank, and I said it at the start, to buy some Bitcoin, transferring some of his gold for Bitcoin. Frank, did he convince you on this?
Not yet, not yet. I think that maybe there might be a time if Bitcoin corrects, which I think has had an incredible run, it's due for a correction, and it might be a very big correction. Yeah, I might buy some because I think it would go higher, and I'll speculate to have a position in Bitcoin. But as a store of value, absolutely not. Not yet.
Frank, nice to meet you. If you buy Bitcoin, I'll buy a case of your olive oil.
You've done your research.
I'm sure we can all meet at a beautiful cocktail lounge or bar one day in the future and continue this discussion. And we could all be friends. So
I'm going to keep cheerfully after Frank.
Thank you both. Thank you so much. And thank you for watching the great gold versus Bitcoin debate here on Stansberry Research. I am honored to have moderated this incredible debate that will go down in history, I am sure. Thank you for watching. I'm Daniela Kumbone. creation of some of the world's leading mining companies. Frank is considered by many to be a modern Renaissance man, having founded Lionsgate Entertainment, Modern Farmer, Dominica Fiore, and a long list of other ventures. Today, he dedicates most of his time to his philanthropic work. He most recently launched the Million Gardens movement alongside Kimball Musk. Frank has publicly stated he was coming into this debate with an open mind, but wanted to challenge Michael on statements he has made on gold and Bitcoin. Today, Michael and Frank will be battling it out in perhaps the most important debate ever to be held on this subject of gold versus Bitcoin. Cyber Hornets argue that Bitcoin represents a powerful digital network that will thrive, a quasi-technology stock without profits or CEO, but with near-perfect security and distribution. Gold bugs, on the other hand, say gold is the ultimate and timeless store of value, that it is an asset that the financial system will turn to time and time again whenever there's a storm. But I'll leave it to the debaters to battle this out. I'm going to go over the format and the ground rules now. This debate will cover 6 topics along with an open and a closing statement from each debater. They will each have 5 minutes per topic, except for the close where they will have 6 minutes each. Once they have made their points in the 5 minutes, the other side will have a 1-minute rebuttal. I will be acting as moderator, and hence there will be no follow-up questions from me, but we will be moving on to the next topic. All right, well, welcome. Frank Giustra joins us from Los Angeles, and we have Michael Saylor in Miami. Gentlemen, I have eagerly been awaiting this day, so welcome Frank, and welcome Michael.
Thank you. Great to be here.
Thanks for having us.
Awesome. So as I stated in the opening, we're going to start with opening statements. You'll have 5 minutes each here. We decided ahead of the debate, and Michael will kick things off for us. This will be 5 minutes of uninterrupted time. Please consider it your blank canvas, in a sense, to set the statements you'd like to make during this debate. Michael, please kick things off for us here.
Thanks, Danielle. So the debate is Bitcoin versus gold. I think that all gold holders and all Bitcoin holders agree on sound money principles, and the real debate is which is the best monetary system in order to pursue the ideals of sound money. So I think we start with some basic ideas. First of all, human civilization rises through channeling energy. We invented fire, that's capturing chemical energy. Then we build our cities next to rivers, we're capturing water, and we're channeling gravitational energy. The aqueducts were critical to the Roman civilization. When we compress air in a canister, we're channeling pressure. Electric systems and batteries are channeling energy. Lasers are channeling photons. If we want to better the human condition, we need to be able to capture, store, and channel that energy. Money is energy. Money is a store of value, and it's also a technology that allows us to trade that energy over time and space. So if we look at the history of money, we've gone from commodity money to coinage of those commodities, to notes represented by that money, to fiat currency, and now we have cryptography as a basis of money. Now, sometimes gold advocates say that gold is the ideal money. Well, really, the ideal money, if God came down and God waved his or her hand and created the ideal money, it would be based upon Luca Pacioli's modern accounting principles of double entry accounting. And if you had godlike power and you could implement a double entry ledger like Pacioli introduced in 1494, and perhaps you could define 21 million units that are infinitely subdividable, trillions and trillions of times each, you could maintain that in magic space, and then you could settle everybody's trades instantly everywhere on Earth, everywhere in the universe, in a fair and equitable fashion. That would be a good money. We could call that God coin. And God coin is like perfect instant transactions, never losing any information. Well, the next best thing that we've invented as humans is Bitcoin. So Bitcoin's the most efficient monetary system we've yet to implement successfully. It's 21 quadrillion Satoshis, 350,000 transactions a day. It cost about 10 basis points of the monetary network to clear those transactions and to secure the network. and it stores the value and provides security to everybody on the network effectively for free after those transaction fees. Bitcoin's the most disruptive force in the century. In 12 years, it grew to $1 trillion in monetary value. That beats Google, Facebook, Amazon, Apple, and the like. That's the market sending us a message. It's the next chapter in the mobile wave. We digitized our photos, we digitized our videos. Now we're going to digitize our money, and our currency and assets are going to flow to billions of people. Money is collapsing. We've got a massive inflation problem. We're losing 1% of our value in currencies every single month. Humanity, without an effective, strong money, is like a type 1 diabetic without insulin. You can't store energy, you can't create fat, you're going to starve to death. Without delivering effective money to the human race, everybody's going to either economically freeze or starve to death. Violence and misery are going to follow. Gold's not a solution. It's not practical to distribute gold in small quantities to 5 billion people. Bitcoin is a solution. It is spreading at more than 200% a year. We're adding 3 million users a week. It's accelerating. If I wanted to give knowledge, music, and money to the world, in the 19th century, you did it with books, pianos, and gold. They're now antiques for the elite. In the 21st century, you're going to use the internet platform and Bitcoin, and you're going to provide iBooks and Google and YouTube. You're going to provide Apple Music and Amazon Music and Spotify to everybody, and you're going to provide Bitcoin as an asset for everybody. Gold used to be the best solution. It isn't anymore. The time has come to pass the torch from gold to Bitcoin. Bitcoin's humanity's first effective engineered monetary system. It's as profound as our rail networks, our road networks, our electrical networks, our telephone networks, and the internet. Bitcoin can and will deliver the virtues of strong money the gold idealists have long hoped for.
Michael, thank you for your opening statements. Now we'll go to Frank Giustra with your opening remarks. Please, 5 minutes of uninterrupted time.
Thank you. And Michael, thanks for agreeing to this debate. And congratulations on your Bitcoin position. You've done very well. And I'm looking forward to exploring the facts, okay? So as I've said a number of times recently, I don't have a problem with Bitcoin. I think it's here to stay in some form or some value for some purpose. I'm not sure what that purpose is yet. I do have quite a few issues with the way you and others have made certain claims about Bitcoin. And I want to point out the risks that exist but are never addressed. And I want to defend some of the statements that you've made about gold. And in doing all that, I'm hoping to draw a distinction between what Bitcoin is, what it isn't, what maybe it aspires to be. Understanding that distinction is very important because you need to assess that distinction to assess its risk profile and therefore where it fits in any given portfolio. I think our viewers deserve to know that risk, and they need to know how that distinction happens between gold and Bitcoin. I don't think Bitcoin is a safe haven asset yet. I think there's a very good chance it never will be. I think it may aspire to be, but aspiring to be something doesn't make it so. And sometimes I dance around the living room in my underwear, but it doesn't make me Madonna. So as far as your claims on gold, I'm not really sure what you're trying to achieve by disparaging gold. I mean, I do have a theory, and you're welcome to correct me if you think I'm wrong, but I think
all the way down, entire economy of the U.S. is JP Morgan all the way down. The first headline, former JP Morgan banker gets FINRA ban after bilking his wealthy grandmother. A former JP Morgan financial advisor has been barred from the industry after being accused of trading his grandmother's assets without her knowledge. So FINRA banned him, and he had apparently put $80 million of her pension or her retirement savings into private equity sort of funds where he was collecting more of a fee, of course, his cut.
She DK'd the trade, which is means declines knowledge. Declines knowledge. So this is something as a broker you don't want to see on your desk, a memo saying your client DKs this trade. So she DK'd the trade, and she went to court, and she won a settlement, which is very, very rare, because typically when you sign on to a new account form, you go to arbitration, which is staffed by a panel of brokers and bankers, and very, very few dollars are clawed back from this type of scandal. And but it was so egregious and so rotten that this grandmother finally did get some money back. But you're right, J.P. Morgan kind of sets the tone of America business mores, and they're all crummy.
Well, when you look at the economy and you try to ask yourself, well, how did this all happen? How do we have mass homelessness? How do we have all these bubbles all over the place? How is the structure of the economy so financialized? And then you're just hoping that, you know, somebody's nice to you, that somehow somebody's going to come in to rescue the system. When over and over we've seen, especially since 2000, they come in to rescue J.P. Morgan. And J.P. Morgan and banks in general are filled with people like this, who will literally bilk their grandmother rather than not get their Christmas bonus. So we're going to look at some data. You know, when I saw a lot of people tweeting that story, it's a recent story, so it made me think of what Lynn Alden, who is a financial analyst, was recently looking at in terms of macroeconomics and the situation in America, whereby, you know, we have a problem with the voters, the deplorable people in this country who keep on voting for populist, you know, sort of politicians that they want. Well, here's the data that she points to say, well, perhaps you need to address these issues, and that might get rid of the need for populist, you know, politicians. Over the past couple of decades, U.S. labor share of GDP has decreased to being well below trend, while U.S. corporate profits as percentage of GDP have increased to being above trend. So here are those two trends. Labor share, as you see, has plunged since the 1950s to all-time lows during, you know, after the financial crash, then in the Trump administration. But last year it did jump a bit with all that stimulus that was given out and the enhanced unemployment benefits. And we see, of course, especially since 2000, corporate share of GDP is, in terms of profits, has absolutely soared. So these are two trends going on, especially since 2000.
Right, so this is real graphic representation and evidence that American economy is very similar to that of Saudi Arabia, right? But not pumping oil, they pump cash. They pump money out of the free money printer machine down to the Federal Reserve Bank. So they don't need workers. They don't need labor. And labor has no rights, and workers don't get anything. The people who are pumping the money down there, the Fed and their friends, they just get more and more of a percentage of the GDP. And it's run by, we have the oligarchs in America, they've got the princes. They've got a certain philosophy about life and liberties. So does America. It's called advertising and Rachel Maddow.
Well, of course, you do, as we recently covered, you get too many elite. You see that in Saudi Arabia with, you know, people like Prince Al-Walid being hung from his feet in the Ritz allegedly, and his fortune taken. The same thing is essentially going on versus Fox versus MSNBC. They're fighting for the decreasing remnants of an empire, like what they get, the exorbitant privilege. But, you know, 2000 is quite important because, of course, we went off the gold standard in 1971, and that set in motion the possibility for what happened in 2000, which was the President Clinton, as he left office, three things he did. He got rid of the Glass-Steagall Act. He also got introduced the Commodities Futures Modernization Act. Those two helped the banks plunder, like J.P. Morgan banker plundered his grandmother. It helped banks plunder the productive capacity of the economy. And then, of course, that couldn't have happened, however, without somebody being able to produce all our goods that the wealthy need, and that is China being elevated to the WTO on favored nations status.
Right, the trifecta of disembowelment of the American middle class, thanks to Bill Clinton. And we're living with the consequences now because the society in the U.S. is irreparably crushed by these oligarchs running the show. And the social unrest is growing, and there's really nothing to stop it anymore.
Yeah, and there's supposed to be this notion of an invisible hand, and the invisible hand is that, you know, your nation and the economy will take care of itself. Like, it will all not do like what that JP Morgan banker did and bilk your grandma. Like, they're supposed to be, like, the tenets of this capitalism are supposed to be based on that sort of notion. You're not going to bilk your grandma. You're going to, you know, your individual self-interest is supposed to help everybody. And yet here, like what we're seeing, as you mentioned, the oligarchs, like the elite, that the setup of the system, once they got rid of Glass-Steagall, once they introduced the Commodities Futures Modernization Act, and once China became part of the WTO, then really you got the exorbitant privilege that went to, like you mentioned, like it's like pumping oil. They get to print credit and credit and credit and credit and get whatever they want from the rest of the world. You don't need the domestic population any longer. The thread continues from Lynn Alden. In addition to being partly due to technology and automation, another part of, you know, the decline in labor share of GDP is due to structural U.S. trade deficits. The U.S. exported large portions of our supply chains overseas, and foreigners took those dollars and reinvested them back into U.S. equities. So here's a chart showing the U.S. trade deficit. You know, so flat while we were on the gold standard, of course, because you do not want to have a trade deficit because you're going to send your wealth overseas. And then, of course, it started to wobble once France asked for its gold back, and then the United Kingdom did, and then we shut the gold window, and this is in the 90s. But look, from 2000, whew, the huge explosion in the trade deficit. That is jobs being thrown overseas. This is what is happening there. And the dollar has become a genuine world reserve currency, all fiat. And the exorbitant privilege, however, has gone exclusively to the top 1% who own the majority of equities, which were bought with all that money from overseas. So it drove up their wealth.
Right. So there's a huge schism in American society due to financial engineering, because you can essentially outsource your jobs to China while simultaneously having China buy stock in your company that you've enabled the outsourcing of those jobs to China. And so that mechanism is rewarded by trillions of dollars worth of ill-gotten wealth. This is wealth that's effectively been stolen from the middle class, from labor, from the average American, and put into the pockets of the kleptocratic class that now rules America. America is ruled by plutocrats and kleptocrats, and we have basically a feudal system, and there's nothing like representational democracy anymore. That's clearly dead.
Well, there was a study, I think it was from Princeton a few years ago, it was like 10, 15 years ago, where they showed that the ordinary citizen has almost no input on actual legislation. So that, obviously, that legislation that President Clinton back in 1999 through 2000, what he passed was written by Robert Rubin and bankers, essentially. He got rid of Glass-Steagall and introduced the Commodities Futures Modernization Act, and, you know, elevating China into the WTO. Those were specifically done for a certain group of people, and these are the consequences 20 years later, 25 years later, 22 years later. So since the top 1% own 53% of U.S. equities and the bottom 50% own less than 1% of U.S. equities, and many of them had jobs and wages impacted by offshoring and automation, this trend of declining labor and increasing profits and valuations has favored wealth concentration. And you show that the chart that everybody knows, the gap between what the bottom 50% used to be paid went all the way to the top 1%. Gather that. And she also points out that now the trend is because U.S. equities are so high, they're at all-time highs. What are these foreign nations doing? They're buying up the housing stock. So you're more and more likely to be renting your landlord is likely to be, you know, these huge funds from overseas where we've sent all our jobs and all our income. So, you know, there's that as well. A neo-feudal, global neo-feudal class, essentially.
Yeah, I think that will be an interesting new chapter in all of this, is that after all the jobs have been shipped to China, the majority of American landlords will be Chinese. And so most people will have lost their job from China. They'll be addicted to fentanyl, shipped in probably from China, and paying rent if they can afford a house to someone in China.
The point is that these were choices, deliberate choices,
yes,
that had to be debated in Congress and the Senate that passed those two bodies and were able to change the system, whereby now you're seeing the demonization of China coming from the Biden administration for the very thing. Biden was in power. He was in the Senate at the time when these three things passed to cause this situation. So, you know, now they're, of course, like pretending that it had nothing to do with them. Like, it's that classic moment. There's drinking going on in this establishment, or gambling, whatever it is.
Yeah, to be clear, I'm not blaming China.
Yeah.
If I were China, I would do the exact same thing. If country like America is going to ship you trillions of dollars, ship you hundreds of millions of jobs, and open the floodgates to you reversing the opium war and doing the fentanyl war back to the U.S., of course they're going to do it. And as you point out, this was the choice made by America's politicians. Chief among them, of course, was Joe Biden.
Well, this is, again, these are deliberative structures. The J.P. Morgan banker, he deliberately bilked his grandmother. He had a choice not to bilk his grandmother. The legislators and the politicians at the time, 20 years ago, you could see a few debates, like the likes of Lighthizer in the New York Times argued against doing all this stuff. And he said that he warned of this. He warned that huge trade deficit would emerge and jobs be sent overseas. And everybody mocked him and laughed at him and ridiculed him, and they did the smug stuff. But we're now at this situation where everything that was predicted by a few individuals back then who were ignored is now coming true. So again, I'm just saying that I think it's probably a better idea to look at what we did ourselves rather than just like start a war with China.
Oh, that huge sucking sound you're about to hear is a break that we're going to take. And when we come back, much more coming your way.
99% of people are living in a delusion. America is in crisis. Social unrest, soaring unemployment.
must have been my imagination. It makes me realize how desperately alone.
Hi, here are some selected objects from Heikin's Nook. Object 41326, Twin 01.
We've kind of gone back and forth with the race. We get hit, we get rushed back. They get hit, they get rushed back, and it's kind of back and forth. But I think the most important thing is just focusing on the game. We go out there and play, and let our play do the talking. I think that's the best way, best outcome for both sides. Yeah, tensions are high. We've kind of gone back and forth with the race. We get hit, we get rushed back. They get hit, they get rushed back, and it's kind of back and forth. But I think the most important thing is just focusing on the game. We go out there and play, and let our play do the talking. I think that's the best way, best outcome for both sides. Yeah, tensions are.
Hey,